All right, let's get some analysis on what to do with this jobs data. We've got Bob Dahl, he's the Chief Investment Officer at Crossmark, and Stéfane Marion, he's Chief Economist at National Bank of Canada. Stéfane, I want to start with you. It seems like Canada's job growth continues, resumed its hot pace, but there were some signs of pockets of weakness. Unemployment ticked up. Wage growth wasn't as high as we expected. Does any of this change what the Bank of Canada is likely to do next week?
I don't think so, Amber. I mean, the job numbers were crazy strong, particularly if you look at full-time employment up more than 100,000, best performance in 5 months. I know the unemployment rate edged up, but that's mostly a reflection of the super strong population growth that we have on this side of the border. Population is growing at 3%, working age population versus 0.5% in U.S. Amber, in the second quarter, population age 25 to 54 outpaced that in U.S. I mean, we're up more than 100,000 people. I mean, we've never seen this before. So very, very strong. The unemployment rate is edging up purely because of increased population. And that's why wages are coming down. But the push on aggregate demand really strong. The Bank has going to hike.
I mean, we've talked about this before. If that is in fact what's driving the situation, I don't see another quarter point changing what that means for the economy. Does that mean that the bank will have to go materially above 5% to start to have some impact?
Potentially, Amber, unless the fiscal policy becomes less generous. Recall that Ottawa will be sending checks again this week to ease the strain from higher inflation. So here you have the Bank of Canada hiking rates, super strong population growth, and on top of that, fiscal policy is still stimulative. Something has to give. If not, the Bank of Canada, you're right, will have to hike more.
That sounds like a kind of a very tough spot for the Bank of Canada to be in, and an outcome that puts a lot of pain on people that might not actually help solve the problem.
You're right. I don't know how you can compensate for population growing 1 million a year in this country right now, which is unprecedented for two years in a row. The pressure it puts on housing, which is a big component of inflation, is something that's really, really hard to fight with just interest rates. So either supply comes back with super strong housing starts, if not, inflation is going to be stickier. And unfortunately, I don't think the Bank of Canada needs to raise all that much, but rate cuts will be delayed through the second half of 2024. So that's not very pleasant.
Okay, I want to bring in Bob now and broaden it out to the U.S. markets. It's interesting, Bob, on a day where we saw that disappointing economic data. At least today, equity markets aren't really sure which way definitively to move. Do you want to cheer bad economic data, or do you want to still think about the fact that this doesn't really change things? You know, it's still too hot for the Fed to pull back materially on its rate hiking campaign.
Absolutely right. Remember, we had a big down day yesterday on the ADP numbers that were so strong. This report did not corroborate that, was a little on the weak side. In fact, the first below consensus jobs number in 15 months in the U.S. So it's been a long string of very strong numbers. And of course, revisions were more than 100,000 jobs to the negative. So there's a weakish report, with the exception of the fact that wages were up 0.4%, the strongest since last July, year over year, 4.4%. That can't make the Fed very happy.
I wondered if this means, though, this touted recession slowdown is finally starting to show up as we see signs of a weakness, if we can call it that, in the U.S. job market.
Well, there have been lots of signs of slowing in the U.S. economy. Labor's been the one thing that stood out. Now we're seeing some cracks in there. Look, 209,000 new jobs is not a bad number. It's just not what was expected. So I think we will see more weakness in labor and elsewhere, and that the U.S. will have a mild recession commencing sometime after into the fourth quarter.
What's that going to mean for assets?
I don't think great news. I mean, I look at equities and I look at my screen, I see 22 times trailing earnings, 20 times forward earnings, which I think are too high, an inverted yield curve, banks slowing their willingness to lend, liquidity concerns. I put that all together, and it doesn't seem like there's a whole lot of room for upside.
Stéfane, I wonder if you could pick up on that point. I know a few weeks ago you put out a really great chart that showed, while big tech is increasingly a big part of the market cap as a share of profit, it's actually been declining. And that kind of speaks to the valuations, that a lot of this expansion in the market has come from multiple expansion, not earnings expansion.
Yeah, to echo what Bob just said, if you look at the earnings yield in the U.S., it's actually below the yield that you get on a 3-month T-bill in the U.S. So cash is yielding more than equities right now, unless you believe that the economy is insensitive to higher rates. Last time we saw cash yielding more than the earnings yield, Amber, you have to go back to 1999. So that speaks to me as very stretched valuation. So either we achieve a soft landing, if not, if it's what Bob's scenario is speaking to, and we agree with that scenario, then something from an equity market perspective, these valuations have to come down to earth.
They have to come down, or can they just hold in and we lock in the gains that we have seen so far this year? It sounds like you're more in the correction or pullback camp, Stéfane.
Volatility, I think it's too complacent at this time. This time in the cycle. So I think that as you reassess the collateral damage on the economy, you have to reassess your growth or your expectation for earnings growth. And as Bob said, I think these expectations are just too strong at this point in time. So we see more value in cash, unfortunately, than equities right now.
Bob, Stéfane just brought up a good point about volatility, just how subdued it is. Does that speak to complacency in your mind?
It does. I think a lot of people have kind of said, well, the market's going up, or at least 10 stocks are going up. I guess I'll just buy some. So volatility in equities has stayed low, even as volatility in fixed income has moved somewhat higher. I agree with his comments about earnings. I mean, the first quarter earnings were less bad than expected, so better than expected, but analysts didn't take up their full year numbers, which implies they're taking out what the first quarter beat was from the second, third, and fourth quarter. So earnings are, I think, still a bit too high. Even without a recession, we get a recession, they're probably a fair amount too high.
Okay, so Stéfane just said, just looking at the yields that you're getting in cash versus from equities, cash is the better play. Are you completely out of equities? What are you doing in your portfolio, Bob?
For sure not. I have many accounts that are always fully invested. So we're focusing on earnings predictability, earnings persistence, quality measures, watching valuations carefully, looking to make sure we have growth and free cash flow. And you can find a lot of stocks that fit that bill, but the overall market probably has some valuation to come out of it.
All right, guys, we got to leave it there. Thank you so much.